Okay, everyone. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy here at TradeStation. It's great to be with everyone. I'm going to start off as usual with my normal disclosures and share some information in the chat. Great to be with everyone. As usual, we're continuing to start using this different software to be live on Twitter and YouTube. So just making sure everything is working correctly. I'm going to share some information in the chat, disclosures and other interesting things. As usual, if you go to tradestation.com and go at the top of tradestation.com to the Insights button on the main navigation menu, it will take you to our blog. And there you will see a blog post with most of the information we're going to be covering today. Although there is some other interesting stuff that popped up this morning or late yesterday I did not include. And we will be covering that, especially about AI and Alphabet and advanced micro devices. Okay, so if you're in tradestation.com, you go to Insights. And then you go to this article right here, Stocks Pause at Key Level Before the Fed. So lots of things I'm going to discuss, but first I want to point out that you can download the workspace we're using. If you have the TradeStation platform, you can see a lot of things that we are doing and the different tools that we use. If you have TradeStation, you can go to a zip file. And if you go to the zip file, it will bring you into this folder. And this directory has a series of easy language documents, which are basically indicators that I've created and special indicators that work for some of the analysis we do in this webinar. And then once you've imported those into your TradeStation platform, you can open the different workspaces, which are listed here with the blue icon. And those are the ones that I'm showing here below. So this is the zip file if you want to use it. And remember, that's going to be available to you at the top of this blog post. Downloads available here. We also have our trading view ideas right here. And the sign up page for next week's, for the upcoming webinars. We're going to be doing this, today is the 7th, and then the 14th will be the last one we do this year. So be sure to tune in. All right, so first, we always talk about the S&P 500 first. And what's interesting today, as I look at it overall, is that, we've had this very, kind of strong run. And now we're sitting in an interesting spot where we're forming an inside week following, 5 straight positive weeks. So it's a kind of normal sort of consolidation pattern. Now, to kind of highlight this, let's look at a few of the things that we often want to do when we look at the S&P 500. First, if you look on a weekly chart, and we just have one right here, there's a weekly resistance line coming down that we're kind of continuing to hit, and then at the same time we have this horizontal line across the top. So I have a lot of different charts. So this is one I'm going to look at today. Basically, you can see that we're at these highs from July. And what's also interesting to me is that we see here that RSI has been overbought, and we have essentially this 10-day moving average coming up. Now, in my experience, usually when you hit the 10-day moving average like this, it often actually means the market is getting tired. The market wants to stay above it. And then, so from my perspective here, I'm looking out, and what I'm seeing is I'm essentially seeing that we have the Fed meeting on Wednesday of next week. The market has, gotten pretty excited or optimistic that we are going to have the Fed get more dovish. There's a lot of reasons to believe that. We've discussed a lot about how inflation is going to come down. Last week we talked about how inflation was probably going to be 2%. 0% again. When we get the numbers on Tuesday, the 12th of next week. But at this point, that is something the market can see. The market is anticipating, but will the Fed see it, and will the Fed act as we hope? That's another question. So I want to point out that we're stuck at resistance, and we still have some time until we have confirmation. That might create the potential, of a kind of stalling and breaking down. The jobs report tomorrow is something, in my view now. The jobs report itself is actually getting less important. We know the economy to a certain extent is starting to show some signs of weakness and slowing. That's something I'm going to be talking about. But again, the question is, will the Fed react the way we hope? And so we have to wait until Wednesday to find that out. So it's interesting, if you look here, I'm going to zoom in really quickly. On the daily chart, you can see we have an outside candle And then now today we have something of an inside candle. I'm going to jump over to this intraday chart that I've shared with you guys before. This isn't a zip file. It just has a, it's dated to the 19th of October. But if you look at this now, I'm going to switch out now to to hourly candles here really quickly to show on the S&P what we've kind of seen here. This is going to take a second. I probably have too much history in this. I have some studies on here, but the key thing is that, let me actually, I'll just use this. We have a triangle forming. And one of the things I've learned is that when you see a triangle, if you think you see a triangle, you almost always are seeing a triangle. I've noticed these before. It can get very kind of exciting. You're like, oh, well, it's more like along here. All right. So remember, these are hourly candles. So the key thing is that when these sort of patterns form, you got to be careful because, it can look like we're making higher highs and that's exciting. But if you look at it right here, we also see that, this peak from yesterday. And so I wanted to just kind of point this out because, my perspective here, going into the Fed, we had an outside day yesterday. That's a reversal pattern. Something of an inside day today. We also have this potential triangle forming. We're at a longer term resistance level from last year and the trend line falling like I showed over here in this chart. And then the other thing is, if we look at some of these other indicators, we've kind of created this proprietary thing to market trends. When we look at the crossover, I'll look at this one. We look at the crossover of this is a number of stocks above their 50-day moving average versus the stocks above their 20-day moving average in the S&P 500, the blue line and the red line. Now, we've noticed many times that when these crossovers occur, they can be an interesting signal, for the market overall. And what's interesting is like, we saw this has been in a positive state really since all the way back here, the beginning of October. It worked briefly. Then we had a lot of negativity at the end of October. But what's interesting is this is now actually given something of a weak signal. So from my perspective here, we could be in a situation when the market has to consolidate for a couple of months. Because the fact is, if you look back at other moments in history when the market broke out to new highs, like especially in late 2016 and early 2017, it did kind of consolidate near those old highs before it really started moving. The market might want more of a sense that the Fed is actually going to start cutting rates. And that could be something that, if you look at most of the projections, that would be looking towards something like March. So at this point in time, there are some real positives here. But we also have a situation where some of the data is starting to actually get a little bit toward that recessionary spot where we're not there yet. But, a bad payrolls number tomorrow and a hawkish Fed on Wednesday, those things together could actually have something of a negative effect on the market. So I think we have to just realize here, there's a lot of things that look positive, but we don't yet have that clear confirmation. So the other thing is I want to just mention that, if, for example, things do take more of a bearish turn, the level I'm watching now is going to be this level around 44.60 right here. This was the level on the 14th of November when we had the strong CPI report. We gapped up. It also matches a monthly high from June back here. So this is a high in June. It was actually right here, June. This is the end of June right here, June 30th, this candle right here. You can see how it nicely matches up. So this is a level right here where if things, want to take a pause and pull back, this would be a level I, would be looking at as potential support. And I also want to be clear, though, that in my perspective, there's nothing bearish really on this chart. I'm not trying to present any kind of sense that things are going lower. It's just more a question of one of the principles that I follow is to wait for these big events. When you have a major event like the Fed, the market will move before it. In this case, we've rallied into it. And, the question is that creates the risk of a sell the news. It also creates the risk of a range bound trade into the event. So I want to just kind of point that out. Overall, I think the conditions continue to improve overall. But we are starting to see some evidence that, the economic condition might be starting to kind of, weaken in a more substantial way. Also, I wanted to point out, I don't have it on this chart, I have it on one of these charts. MACD is turning negative. And those are the main things. Some of these other indicators, stochastics were overbought, RSI was overbought. So none of these things are overall kind of bearish. It's just a question of having that, potential for a kind of pause kind of in the market. All right, now I want to now just kind of look at, let's actually look at this article that I had done recently on Market Insights, because I think this actually does encapsulate a lot of the stuff we want to see. 5 key charts. And we're really seeing here, first of all, this kind of, this is the JOLTS job openings going back to where it was before the pandemic. This is the 10-year treasury yields collapsing, oil collapsing, as we've talked about a lot. Now, this is the Atlanta Fed. I actually have an updated version of it here, but you can see now that this is what I'm talking about on the economic front. We've basically went in the middle of November. We were looking at around, if you actually go down, what's it say? It says like 2.2 on November 15th. Now we're down to 1.2. So this is the estimated GDP for Q4 that we're presently in, just as real kind of slowing. So a lot of things have kind of tilted in that direction recently. We've seen it with the, like, for example, factory orders, a big slowdown. And so to me, we had the JOLTS number weaken, ADP payrolls missed. We continue to see slowing in wages. The productivity was really pretty amazing, the number we saw. When we first started looking at this, and I remember, if you go back and look at the video we did on November 2nd, we basically said that this was the single most important news event that had happened in a certain amount of time, in several weeks or months, was that we basically saw a huge downward number on unit labor cost. It was supposed to originally go up 0.7, then it went down 0.8, and then the final revision that came out this week was minus 1.2. So you're basically looking at a huge non-inflationary event here. Productivity much higher than originally expected. So these things are what the Fed wants to see. Overall, a sort of, very positive macro environment. And I think that's why it's important to really not in any way, really be thinking things that are excessively bearish here. We're in an environment where everything is coming together in many ways, in a way that the bulls would want to see. But again, the question is, will the Fed, once bitten, twice shy, when they already messed up on inflation, 2 years ago, will they be, eager to come out, or do they want to see a little bit more evidence? And I think that's really the question. Now, remember, I didn't include it, but if you go to Nowcast from the Cleveland Fed, you can see that, this is the number. This is why I'm saying that inflation was flat last month. This comes from the Cleveland Federal Reserve. And so, I mean, we're still looking at a situation here where these inflationary numbers have been interesting. So anyway, the guy at Walmart, the CEO, Doug McMillon, said wage pressures are reducing. A lot of the other things that I've been looking at have only increased these trends that I've been citing that will essentially be positive. And I have to say, this is almost like a joke at this point in time. If you look at what's happening in oil, Chevron increases its spending. Suncor increases its CapEx. There was another one, record U.S. shale output. Okay, we have all these articles here. Let me just see if I can. Here's another one. I was on Twitter. This guy was showing record American oil production for next year. We're going to be, look at this. This shows that Chevron's production is going to go from around 600, something thousand barrels a day to like almost like over 850,000 a day. ConocoPhillips. These companies are all, according to this guy, this was something from Wood Mackenzie. This guy is on Twitter. One of the people I follow had retweeted this, but I thought this is kind of interesting. Now, again, I'm not just cherry picking this guy out. This matches what we've been talking about now for, several weeks. We've been talking about this back here. We did an article about the massive surge of oil production that was coming. And we did this back. Actually, this is a different one on energy, but we had talked about what was happening in energy back, in the first half of October, how this was coming, and it has played out. The downside of the energy stocks have played out more or less as we expected, and as we kind of saw the pieces coming together. So 1 second. Let me just really quickly. I have a request from someone. I need to do something really quickly. Respond to. I apologize. I have to. Okay. The thing is, we've talked a lot about what's happening in energy. We had done this idea on TradingView, and it has more or less kind of played out. The energy ETF is hitting its lowest level in several months, and we had done this idea here on TradingView, and we put up on the blog. We did this other thing on energy, like I said, if you look back, basically the weakening fundamentals in oil. So anyway, what we've been saying about oil continues to happen. We've had multiple stories confirming it. So I'm going to go ahead and close those. So let me just close these so I don't repeat them. This idea of all right, just close all these. Now, let me just jump over to the interesting stuff. Google launches this Gemini, significant innovation in generative AI. This was an interesting story today. So today we had two big tech stories with Google launching this new product that's supposed to compete with ChatGPT. Here you can see a chart of Alphabet or of Google, and basically it's interesting. Goes right up to the top of that Keltner channel and kind of sits there. So this company had some other issues. The last earnings were not great. This is something where, I'm not sure what kind of real visibility they gave in terms of how they're going to monetize this the way Microsoft has. Google has not as clearly, managed to monetize things like their, Google Docs and all these things that in theory should be competing with Microsoft. And in theory, those are going to be the funnels that they use, or the actual channels they use to sell these AI services. So the market, I think, still needs more confirmation of that. But that was a big story today. But the other big one was AMD. AMD, Advanced Micro Devices, apparently is now going to be having its chips used by everybody, by Meta, by Microsoft. Let me see the article. AMD, Microsoft, Meta, and OpenAI are using its latest chip. So the thing is that AMD now is reestablishing itself. For a while it was lagging NVIDIA. And it's funny, AMD used to, basically used to play back and forth with Intel, and now it's playing back and forth with NVIDIA. It's like, Tweedledee or Tweedledum of which one is the chip stock that is doing well. And in AMD had kind of struggled this whole time. It's interesting if you look at when NVIDIA gapped higher back in May, right? And then you can basically see that during that time, AMD basically, did nothing, right? And now if you kind of look, AMD has been moving since the beginning of November, and NVIDIA is more just kind of, it's rallied some, but the momentum here is shifting to AMD. So this is something that these are the big things now. And we're seeing this news come back in here. And I think it's interesting that, we've seen a process here of some of the equal weighted stuff, and a lot of the non-tech things have been performing well, and a lot of the breadth has been improving in the market. And then out of left field, we get this another huge AI catalyst coming here. So let's really see, because it's interesting if we dig down now and we go to our key ETFs and we look at how things are doing in the market, and we look on a trailing 1 month basis. What we can see, I want to look at the equal weighted, because that's always been something that has been important to see. Are people essentially, buying the big tech stocks, or they're looking for other stuff? It's actually over here in my breadth, MT breadth. I'm going to look at 21-day performance. And it's very interesting to see here that the RSP is outperforming the SPY in the last month, really in the last week, the last 2 weeks. Now, when RSP outperforms, it means that the breadth is broadening in the market. We can see it over here in this chart. this is actually one when it's red, it actually shows that the equal weighted is outperforming the SPY, and it shows that there's relative strength in the market. So this is an interesting thing to see, that for a long time here, we've seen mega cap dominance, and now we're starting to really see the equal weighted outperform, which means that people are broadening across the market. And this is not a surprise, I think, when you look at what's been happening. Really, it's very interesting to look at the things that are most sensitive to interest rates. And we're talking about the banks, housing, and real estate investment trusts have really come back to life. And that's really what our what our workspace is telling us today. And this is what the pattern we've seen in the last month. A lot of people have been expecting it, and that's essentially the trend that could be emerging in the market. And I think it's going to be an interesting debate. Will we actually see this trend of small caps and banks continue to remain a dominant trend, or was it a period of was it kind of a blip, and now we go back to the large cap outperformance? Today is more of the large cap outperformance, but it's very interesting to me to see under the hood this continued strength in these areas like financials, real estate investment trusts, industrials. To me, it actually tells me that we are seeing some significant overall breadth in the market, and we really could be at a spot here where conditions are really changing. If we look at MT breadth again, it was interesting for me to see recently that the small caps, had more companies making 52-week highs recently. This was the most in since the summer. But at the same time, the Qs had fewer companies making 52-week highs. Oops. So overall, what we're really seeing is just a very broad sort of amount of strength in the market. And for me, I mean, the trends that we've really been emphasizing here in this webinar have been downside in energy and potential upside in housing. Now, those things have played out. And now I'm trying to kind of figure out where the next steps are going to be. And it's especially difficult before something like the Fed. At this point, the market, it might simply be a spot here where the market is not as concerned about the Fed. It might be a spot where even if they come out with some kind of unclear statement, remember, they're going to have the dot plot. At this point, it's important to remember that they're no longer hiking. So the market can look out and see where the numbers are going. And there's a lot of cash on the sideline. And if inflation is truly coming down the way in various ways we've discussed it appears to be, there could be a spot here where the market could actually just move without the Fed. Now, that is speculation at this point, but I think it's also important to realize last week we talked about the record amounts of cash on the sidelines. And in my opinion, the thing that's really important here is the fact that we have now the beginnings of structural deflation in place. And I think it's fairly likely that we're going to see the big thing and the big enchilada of all is the housing costs. And those are really showing signs of moderating. And it's very likely that, as strange as this sounds, that as interest rates come down, the housing costs will probably go down. And the reason is because you're going to see people vacating apartments and rents are going to drop. And the other thing is there's a lot of houses on the market now. And in many ways, the values of houses are not real values. And the reason is because we don't have a lot of volume. We don't have a lot of price discovery in the real estate market. But once that volume increases, we're actually likely to see prices come down, because a lot of people saw their houses like double in value during the pandemic, and now they're just sitting there, and they've come down a little. But the thing is that people haven't really adjusted to the new normal. And as those transactions start to happen and we get real prices that are in the reality of here and now, we're likely to see prices coming down. The other thing is in many ways, lower interest rates will not just increase demand for houses, it will increase supply of houses. Because the thing is people will say, hey, now I can move. Now I'm, because now it's like, oh, if I sell one house, I have to go to a higher interest rate. Well, the thing, and that means they're not going to sell the house. So in a strange way, what has really happened is keeping those rates high has actually reduced supply coming into the market. And it's actually put us in a situation that, it actually prevents prices from coming down. But as those rates come down and people can say, now I can move, now everything can happen, that's when we're going to actually start to see the prices come down, and then that's going to be a structural force that could drag inflation down, you know, into the future. And I think that's really what the market is looking out to see. So my normal sort of approach would be to look for consolidation before the Fed, with the risk of something of a push to the downside around the Fed. But it's also important to realize that we're in a situation right now where the positives are not hard to see, and the market sees them, and it's a very positive macroeconomic condition that we're in. I'm going to just zip through some of these other things I saw because they were so interesting to me. So this is the CME thing from the Fed, and it's interesting. Let's actually look at what we're expecting in March. Now, remember, the March expectations are not, that's actually not necessarily the date. It's not yet confirmed, but the market is now looking for, a chance of the Fed cutting in March. Now, this is not necessarily, all that accurate or anything, but the thing is that we do see this general trend of the expectations coming down. Another one today, job cuts up, in the last month, 24%. They're up 100%, 115% year to date. There's another thing that argues in favor of the Fed being dovish. So we mentioned this about GDP now. Walmart hiring and wage pressures have eased, according to CEO Doug McMillon. Here's another one I thought was interesting. I'd never seen this before. So I like to look at a lot of different news sources to kind of give you guys, as much of a big macro picture as possible. And I do think it's important. Now, we've been able to identify certain trends because of that. Like, we were able to, I don't know anyone else who was talking about 0% inflation, but last week we were, and now next week, that's probably what everyone is going to be talking about. So teen unemployment, this is an interesting one that I found, is that this tends to rise. This was according to S&P Global Market Intelligence, but they found that historically teen unemployment shows weakness in the labor force. So this is an interesting sort of trend to be aware of. I thought that this also kind of confirms what we're seeing in the JOLTS numbers. It confirms what we're seeing in the, in some of these other numbers, like the ADP, the downward revisions. And, I think we're at a spot now where, I think there's a lot of companies, when you look at the data that's come out from the Institute for Supply Management, the Purchasing Manager Indexes, I think there's a lot of companies now that look out and they say, if the Fed doesn't cut rates in the next 3 or 4 months, I'm going to start laying people off. They're not there yet. But the thing is, if you look, there's a lot of inventory out there. New orders have come down. There's a lot of signs that the economy it's beginning to slow. And the question is does the Fed just give it a boost, or does the Fed keep pushing down on it? So I think this is really the key question here. And my suspicion is that I mean, like I said, I continue to think that if we don't have, something of a communication, of a pivot, of a relatively clear signal of a cut in the first quarter, I tend to think the market's not going to like that. And so I think we guys remember that Fed event is out there. We're in a range, and let's just be careful when we have those conditions. I've often found that, the market will just play with you. It will test those highs. It'll be in a range. It'll poke around, and then all the movement will come in the last 15 or 20 minutes of a trading day. Now, remember, we have the payrolls tomorrow. We have CPI on Tuesday, Fed on Wednesday of next week. This is an interesting article I found. Another thing that was interesting to me, all right, there's another story that popped up today. Now, I'm not sure the near-term importance of it, but I do think it's important to realize that that now this is probably going to be, try to avoid politics on this webinar, and we all think whatever we think, but when politics impact the market, that's when we pay attention. And, the government now is going to, they say they're going to seize patents of drugs if the prices are deemed. So when the government gives funding to develop drugs, and now if they say the prices of those drugs after their creation is too high, now we're going to go and take their patents or something. And I mean, will it exactly happen this way? Probably not. But the thing is, there's an election in 11 months. And my expectation, I don't think it's crazy to say, is that we will probably hear more of this in the new year. And this could be a theme going into the election next year. So I think we need to realize that, drug pricing has been a sensitive issue in the past. And now we're seeing that it's starting to come up again. So I think it's important, and this is something now that's going to kind of be a risk out there for healthcare, for pharmaceutical stocks, and I think we need to just be aware of it. Now there's going to be analysts who are going to start saying this stock good, this stock bad, this company is susceptible to this risk, and this company is not. This is going to now be something that will be a narrative going forward. To me, it's a really difficult thing to try and trade or invest in. I wanted to just kind of highlight this. This is a big thing that's popping up today. Here's an article I thought was interesting from Oxford Economics. So they basically said China has 4 to 6 years before they fix their situation. Now, of course, we also did have that downgrade of China. I think it was on Monday of this week or Friday of last week, but not downgrade. Their credit was revised to negative outlook from Moody's. This just remains an ongoing issue. I saw articles also about OPEC was cutting the price of the oil they sell to Asia. So again, this is a theme we've talked about for months now, and it's also playing out. So, from my perspective, it's ultimately a positive for the U.S. market. We want to see China limping, for the dovish scenario to play out, but we don't want to see them crash because they buy iPhones, they buy semiconductors, and a true, meltdown, a true crash of the Chinese, financial system would be a problem. We're not there yet, and it's not clear that it will get that bad. But you could just be in a spot where they keep limping, and that keeps a drag on oil. They also had a huge boom of exports. In the last, I think it was October and November. The last data that came out showed a big boom of Chinese exports. What does that mean? It basically means, is what I've been kind of saying, they're going to flood the world with cheap exports to prop up their economy. They're going to try and export their way out of the situation. It's what countries have been doing for a long time. They're going to flood the world with cheap products. And again, that's deflationary. So I think that is what it seems to be happening. They're importing much less. They had a huge trade surplus. But to me, it actually is a sign of bearishness for their economy. So, the Chinese thing also remains in the background here. What was the other article here? All right, it's an interesting article. And this is something we had mentioned a while back. The VIX, when it went down to those levels, it went down to the levels of where it was before the pandemic. I look at a long-term chart of the VIX here. And you can actually see VIX.X, $VIX.X on the TradeStation platform. And can I take a look at SPY? Well, I've discussed the S&P 500 here, but we had talked about it going down to this level, which was really the levels from before the pandemic. This level here, you can see that VIX got back down to it, but now it's holding it. So we'll see. I'm like I said, to me, this is, with the Fed coming, this is now going to be a period of waiting. And the question is, does the VIX break to new lows before the Fed? Does the S&P break to new highs? Based on my normal way of approaching the market, the answer to those would be unlikely. So nonetheless, interesting to see this article on Reuters about how basically the low VIX is just drawing risk appetite, people doing leverage trades, more risk appetite. And that's something we can probably see. It does fit in with a thesis of widening breadth in the market as the VIX goes down. Now, another thing we just talked about is used car prices. I saw this article here. If you want to check this out, I heard about this thing called Black Book, and they showed really dramatic drops. Car prices down 2.4% in a week, which apparently was a really big one, and that's accelerating from 1.8. Now, I think the thing is that, used car prices are just collapsing right now. There's a lot of evidence of unsold vehicles, and that, again, positive for inflation. And then JetBlue talked about healthy demand for travel coming back. So these are just some of the things out there that continue to point in that direction, like I said, of demand for travel, falling prices. All these things continue to feed a positive narrative for the overall market. All right, now let's see some of these other items. So airlines have benefited. Now, these are some of the ways we see it on the TradeStation platform, using our key ETF tab here on the MT main workspace. And if you look in the last month, but airlines have really been outperforming. The jets should be on this list. I don't have JETS. Let me add that. So JETS is an ETF that covers, and we can see JETS, the airlines, the banks, the home builders have really been the outperformance in the last month. We've seen strength in biotech as well. And there's been a lot of activity in that space. Now let's see the other main areas I wanted to talk about. We've seen this continuous weakness in energy that I've talked about a lot, the XLE. We had done this idea on TradingView. Essentially, I think it was an interesting one to actually kind of look at. If you look here at more downside energy ETF. So, TradingView, it's an API partner that allows you to link your TradeStation account to this outside charting service and to trade on it. And then we actually publish ideas and chart analysis on there. And it's interesting to see how we had this level in place that it was just, dancing and could not get back above this close from November 6th. And then if you look after, it just kind of continued lower from that. Now, we have talked a lot about the prospect, and especially Occidental was one that we had talked about. And we had noticed this sort of thing that we've seen. So we can go back to, I think it was Solar Edge. It might have been, no, it was, you can see it here, it actually was here. See how it just kind of fades? It just struggles at the 200-day, and then it just breaks lower. This also happened in Coca-Cola, where it, stalled under and then has that knife lower. And now, if this pattern repeats itself, some of these names like Occidental might be doing something similar. It's down here near this 52-week low. However, below that, there is some potential space. And it's also interesting to me, if you look at the XLE, it's on this trade idea here. But if you look at it, this is on a weekly chart. If we actually look at the XLE and we take it on the weekly and we show this trend line, you can actually see now that basically the trend line starts here. We've basically broken this trend line. So from my perspective here, this is something where, given the overall environment, this might see some more weakness overall, especially when you consider all those headlines I just showed you of increasing oil production. So I want to just point this out. This, to me, has been working. And when you look at the way historically energy trades, it could potentially, really magnify itself in the coming months. So those are the ones that, kind of are setting up. All right. So the other thing we mentioned, that it's interesting to look at the FXI of China. China has this similar sort of long-term pattern. This is, I don't know, if you look at this thing on a long-term, this is the FXI. When you look at the debt situation and everything else, this is one that also has just continues to lag. And I think that, when you have a debt drag, and, one of the things that we've talked about is this idea of leverage. This is one that was always interesting to me, was Newell, NWL. This is like, I cite this just as an example because this is a company that has a lot of debt. And when a company has a lot of debt and things go bad like this, you can get these really big moves. I mean, Carvana did it too when it broke. I mean, it just had this incredible downtrend. This was also an overvalued tech stock. But the thing is that when you have debt, there really is no floor underneath the equity. And so if China, as an overall economy, has this, significant debt problem, the FXI can just continue to be dragged lower, because what happens over time is just the cost of servicing that debt just devours any other value that exists. So I think this process we have seen play out many times, and it is happening in China. Well, there seems to be a lot of evidence of it happening in China, I should say. All right. So we also like to look at, we call it the mover of the week. And last week we looked at a company called Stride. This is a company that we look for companies on this that are newer companies. We're doing Pinterest today. And what we're doing is and if you look at actually on market trends here, and you go to last week, you just go up to the top of the blog and you click on this little button that says market trends. it'll take you to a list of all the different blog posts that we've done for the different webinars. If you click on this one with inflation hitting 2%, you go down to the bottom. We have instructions of how to do this in Scanner using the platform. Oh, wait, it was a different week. I apologize. There was another one recently where we showed finding non-index stocks that are running. It must have been the week before this. So we use this. Essentially, we use Scanner. We look for stocks that are making 52-week highs that trade a certain amount of volume, like 500,000 shares a day. They have a market cap of at least 3 or 4 billion, and they're making 52-week highs, and they're near the highs. We look for different patterns like that. And so today we come across Pinterest. So this is pretty interesting because we had done an idea on TradingView on Snap. It's interesting. We had originally done a bearish idea when it was coming off this high and it plunged. And then we did a bullish idea, kind of, or an idea mentioning potential upside right around here of it going up and filling the gap. And both of those things have played out. So it's interesting. I'm sure a lot of people are aware of the things happening with Twitter and Elon Musk and all this stuff. But it's interesting because, you have 2 other social media stocks that are now kind of showing signs of improvement. It's kind of interesting. Now, I'm not sure about this, but you also have to wonder over time what happens to TikTok, as issues with China potentially increase. So who really knows? But the thing is that Pinterest and Snap have both been doing some interesting stuff recently. Both of them are not in the S&P 500, but these are the kind of companies where if they do succeed and manage to, survive as companies, these are the sort of stocks that over time could become major sort of companies, in the economy. Social media stock via earnings and revenue estimates. There were various positive notes that came out after the report. There's optimism about their turnaround plan, and they have an advertising deal with Amazon. So Amazon, always being clever, has started selling ads. They have one of the top ranked websites by traffic in the world. So they say, hey, this people come to our site and we can sell them stuff, but we can also show them ads and make money that way. And so now what they're starting to do is they're starting to have ways to, in this case, to partner with companies like Pinterest. And I'm not sure exactly how it works, but now this is something that people are looking at as being a driver for Pinterest. So the thing is, if you look at companies, we talked about AFRM, recently, their partnership with Amazon. We talked about Shopify, their partnership with Amazon. And now we're talking about, Pinterest, their partnership with Amazon. So there was a day when Amazon cannibalized and destroyed other stocks. They'd say, hey, we're going into your business, and the stock would tank. But now Amazon seems to actually be more of a friend that goes in and they partner with people, and the companies they partner with are benefiting. It's an interesting thing to notice, and I wanted to point this out for pins. Last week we did LRN, and this was one that is an interesting education stock. I mean, we covered it last week. It's more obscure than something like Pinterest, but we try and look at this because, it's interesting to find these individual stocks that are kind of emerging. The great thing at the end of the day about stocks is that you can look at commodities or cryptos or anything you want, but at the end of the day, companies can grow. And I think that's really the thing that's exciting when you're looking at long-term sort of prospects, is to look at those companies that are, not in the S&P 500 yet, that are growth-oriented companies that are showing that they've actually achieved that critical mass where they're going to survive and they can go from being medium-sized to being bigger. And that's really where growth investors often focus for the big sort of opportunities. And I think it's interesting to see it in these names. I just want to mention that we earlier in the year we're talking about Airbnb and Uber, is a possibility over time that these are going to be in the S&P 500, and both of them now are. So Airbnb, we did an idea on TradingView on this one recently when the stock was holding the 50-day moving average, continuing higher. In my opinion, this is one that also is in that sort of, kind of phase of people appreciating it, of people saying this is, a longer term sort of story. It's part of now the American economy. 15 years ago, it was not. Now it is. And that in many ways is, if we're in this growth environment, where attention will be. Uber has had a huge move on its news, But again, this is one that we have been, highlighting and discussing based on this process. And I think it's important to realize that we really are in the continuation of a secular growth market. We're now at that phase where some of these sort of mid-tier names, that's where the attention is. We talked about things like Garmin and GoDaddy. These are also not actively traded stocks, but they've had these really big long-term chart breakouts, and that's kind of interesting. So, all right. Another trend that I thought was interesting was that Twilio and Spotify both have rallied on job cuts. So, early this year, job cuts were a driver in tech, and now there are, that trend is spreading here. All right. Now, look at some of the things here that, to me, I was doing some scans, and one that came up was Meta. So looking for, potential opportunities kind of in the near term here, especially things where we can fire up Option Station Pro and consider, some options-based trades, is something like Meta here. This is one to me that at this moment, it's come up, and if you actually look, it's interesting. I don't have stochastics on this, but it hit an oversold level on stochastics, and also there's a 50% retracement of this level here from the 26th of October through this high. It's holding that level. So this is, to me, pretty interesting. It's also interesting to see that it's holding this Keltner channel. So, at this exact moment, people might see this level from the 16th as some potential resistance and, maybe see a little bit more chopping here. But, I think when you look at Meta on the longer term here, this has had a decent period of consolidation. And if people are looking for extension and continuation, it could be getting in that spot. So I think this is one that will be interesting over the next few weeks or the next just few days, maybe. And the other one was interesting to me was Netflix. So Netflix also is interesting here because we had talked at the time about this one as being good for options at the time, because basically we had this downtrend and it ripped through that downtrend. And it was a different line. The line was lower when we did it before. I had it on a different chart. If you look on TradingView, we did the idea at the time. But now we have, this kind of retracement, and it's kind of trying to pull back and hold this level. So from my, perspective here, this is one that, we could see some chopping. And at this point, it probably has a little bit of time of chopping and consolidation. We have this outside day and now an inside day. Let's kind of see what happens here with this name. I think, holding the bottom of the Keltner channel as well. But to me, this is another example of a case of these long-term growth names that are kind of fighting their way out of weekly consolidation periods. And I think that's kind of interesting. There are more like this. All right. So we had done an idea also. I don't have a good weekly chart on this. I have so many charts. All right. So this is T-Mobile. We did this idea on TradingView recently. Let's just do it as a weekly here really quick. If you look at this, basically since, if you actually look all the way back to 2021 in this case, this stock basically sideways move really since the summer of 2021. Look at this on the weekly, the way it's been making these higher lows. So if you look back historically at T-Mobile, look at what it did here. Had a big move, from 2016. Look at this big move, consolidation, and then continuation. So I want to just point this out. This one seems to be escaping that pattern. Also, AMD. If you look at this on a weekly, let me just zoom, boom, make this bigger. You look at this on the weekly chart, you can also see that this was, the all-time high back here in November of 2021, came down, held 100, and on a weekly pattern, you have something of a cup, something of a handle. This is a classic pattern that growth investors look for. This comes, if you read a book from Bill, I think William O'Neill was his name. It's called, I think it's How to Make Money in Stocks, but he talks about this pattern, and it really is intended for secular growth stocks. It doesn't really work for energy stocks, or it works for secular growth stocks that are in that phase of going from being, a mid-size to a big company. And it's usually for technology, but it's really for growth stocks. He used it to look at certain pharmaceutical stocks back in the 1960s, but these patterns repeat themselves, and we are now seeing more and more of these weekly patterns that are showing that we're setting up potentially for some continuation of the secular bull market. Another one on that list is Amgen. I did a trading view idea on this yesterday, and it's also interesting to see in this, if we look at it on the daily chart, you can also see here that we have something of a bullish triangle. We have higher lows. We're holding this resistance right here. And, I break into it more, but this level here, if you look on trading view, we talk about how this level here was a long-term resistance level. And you can see that here in September and here in October, both times it tested and held. And now we have this really tight pattern. If this thing starts to move up above that 50-day moving average, really, or get above these weekly highs here from early November, this is one that, potentially could have some activity. Now, the one thing I want to mention about this is let's actually see what the analysts say about this in terms of the Joe Biden thing with patents and stuff like that. This is now going to be tricky, and healthcare has not been a great part of the market. But it's still, interesting to kind of point out that this is a name that has performed well. We had actually cited it as an opportunity, I'm pretty sure, back here at the time. I believe that it hit our signal back here in early September because it hit the 21-day moving average. It was rising, this gold line on our chart. And that was one that was interesting. So let me see. All right. I'm now going to, those are most of the things I wanted to cover. Let me know if you guys have any questions. I'm going to just work my way very briefly now through the different workspaces here. These are the key ETFs, and this is, I'll also show you, these are the standardized returns of some of the ETFs we've been talking about, if you want to take a look at that. Remember, if you go to the bottom of the blog post that we have for today, there is a link to the prospectuses for all these different ETFs. I don't have things loaded in this, but this is like our price grid, our MA tool. So if you have this workspace, say, for example, just quickly we bring in the NASDAQ 100 just to make things easy. This will now show us companies that are, for example, doing things like testing their moving averages. So this shows us these are companies like Meta. Today it's testing its 50-day moving average. So it comes up on here. Comcast is interesting also. This one I had noticed before that, it has like this downtrend. This is one that I think is going to be interesting to watch to see if we get a breakout through here. It's interesting how it's, had a false breakdown under that 200-day moving average, came back and held. And now also, I'm just looking at these levels from here, from the first quarter, the first half. You have this level around 40, 41. It was resistance. You see here, exactly this matches the quarter, the second quarter to the third quarter. It comes back, and that's trying to hold that level. So this is one also I think is kind of interesting. These media companies have had all kinds of strange things with them, with all this stuff happening in media. But this is interesting to me. I think there is a downtrend here that people might want to watch and see if this actually does get a breakout. Now, remember, we also have the earnings dates here. I don't have anything on this, but if we brought in the NASDAQ 100 for it, we don't have a lot of earnings until late January. But remember that this tool, you can bring in a list of stocks and you can start planning for options for earnings season. I was going to say for option season, because, trading options around earnings season can be, an interesting approach to manage risk and potentially capture some moves. We have the average options indicator in here to help people identify active underliers. This point is still premature for that, but I want to remind people that we actually do have this as one of the tabs on the workspace. The ES indicator here, the ES workspace, this is one where we look at the 50-hour moving average on the futures. We look at stochastic and MACD. And this had a little bit of a buy signal this morning because MACD was oversold. Stochastic was oversold and MACD turned positive. That is often considered like a buy signal. However, I think if you look on here, you can also see that we do have, this, you can see this triangle on here. You can kind of see same sort of the thing just to be careful of. I've just noticed so many times, you think, oh, it's going to go, and you get all excited. And then that triangle just denies, just comes in and asserts itself and refills back down. And so I just have had this, kind of rule of thumb of myself when I try and trade is, if you see a triangle and you think it's a triangle, it almost always is a triangle. And in this case, that's what we got. So I want to just mention that. Now, remember, we have those payrolls in the morning. Remember this, the signal here was down here when you have two of the three in one direction. This case, the MACD was turned positive and the stochastics were coming off oversold. So that was a potential buy signal on this, at around 8 o'clock, 9 o'clock this morning on the futures. Like I said, the breadth here has been interesting to see the strong advanced decline line. Now, I will add that this signal, of the 20-day versus the 50-day, it gave some really good signals earlier in the year. I'm not sure it's any longer valid. I'll be honest. So, for example, it gave a signal, here that really didn't work. There were other times when it did. I want to just mention that we had looked at this signal before. These are proprietary trade station indexes. And this crossover has historically given some good signals, but there's something that tells me that we could be in a different market here, simply because of the widening breadth and the fact that before the Fed was hawkish, and if they get dovish, it could simply be a new market. We could have a market where REITs are the best sector or something crazy like that. And that could, because there are a lot of REITs and they're all small, you could have this weird, thing where a lot of companies are above their moving averages and the overall index doesn't really move or something like that. You could get something when the REITs suddenly pull back a little and it gives a false negative. So I want to just mention, we had talked about this before, and it's not necessarily giving us any real signals now. What is interesting is the advanced decline line has been very strong in the S&P 500, and the breadth seems to be widening. Breadth has not worked as an indicator for the last couple of years, but it could start to work again. And I think when you consider the extreme levels that some of these things like the Dow got versus the NASDAQ, some of these were so oversold versus the broader market that there's now that potential for money to go into the equal weighted stuff and just stay there and not be too, for people to say these longer term names outside of big tech, people can have that longer term view of them. And if we see that, it's going to be a new market, a new kind of set of indicators we're going to look at. I'm not going to do anything with this one this time. Yeah, those are the main things I wanted to look at. But I want to just point out, we have this kind of triangle. We have the numbers in the morning. And, like I said, my normal approach of risk management would be to be wary until the Fed. The breakout before the Fed might be difficult. And, my concern here would be that if we get a bad jobs number in the morning, you're going to hear everyone talk about a recession. If we get a good job number in the morning, everyone's going to talk about the Fed is not going to cut rates. So I think we're in a situation here where now that we've rallied on optimism, it's setting us up for the potential of falling on some kind of negativity. It's not to say that it's going to be a really big drop, and it's not to say that it's really all that meaningful, but we're just in a spot here where we have a triangle. We have multiple patterns that tell us to be cautious. MACD turning down, stochastic falling from overbought, outside day, inside day, resistance at the July high that, could suggest the need for a pause. And if that does happen, we do have this level from back here on the 14th of November, this low, which also goes back to the June high. That's on the cash index. It looks different on SPY. So hope everyone has a great day. We'll be back next week for our last market trends of the year. Thank you so much for joining us. Go to tradestation.com and check out the things we do. And I hope to see you guys again next week. Thank you very much.